Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. On a monthly basis, I attempt to explain what is occurring in the markets and the economies using a variety of charts and graphs. I like starting with some headlines. Earlier today, inflation was reported for the month of January. It did not decline, it still stays elevated, which portends that the Fed may increase its terminal rate projection, maybe close to 6%. During January, we saw US investors, even during this rally, exit US stock funds. More on that later. Given the higher inflation, given the decline in savings amounts and rates, consumers are beginning to feel the pinch and will, in my opinion, begin to slow down their spending. Bank lending standards have tightened, meaning banks are making it more difficult for businesses to borrow and are loaning those businesses less money. The US cycle indicator for Morgan Stanley has flipped from expansion to downturn. We've had 19 months of an expansion, and this is one of the fastest market cycles by this indicator. This latest change in signal to this downturn is driven by US data that is still generally above average, but deteriorating or stalling, especially in the PMIs and in the unemployment measures. I wanted to touch briefly on PMI. PMI, whether it's manufacturing or services, measures the activity level of purchasing managers in both manufacturing and the services sector. So we can break out the economy into those two pieces. Above 50 indicates expansion, below 50 is contraction. You can clearly see we're split, where services is continuing to expand, primarily as we get more employees into the service sector, while manufacturing is declining or contracting. This is a great, very interesting chart that shows that the S&P 500 calendar year bottom up earnings per share is the solid line, has been declining. Yet at the same time, the S&P 500 has been going up. At some point, this has to correct. Either earnings per share increase again or the S&P declines. We'll have to wait and see. Over the last 60 days, and primarily coinciding with the decline in energy prices, a warmer than expected euro area, and the ending of the zero COVID policy in China, we've seen changes, particularly by Goldman, in the GDP forecasts. And so when we look at the US as compared to the rest of the rest of the world looks as if it's going to be growing faster and potentially is a place where we should move some money. Electric vehicles, which has been a hot topic, from a metals perspective, requires 138% more copper than conventional cars. The EU is planning to only sell new electric vehicles starting in 2035, and currently 17 US states are creating a mandate that in 2030 and forward, you can only buy an electric car that's brand new. These cars require a lot of metals. As you can see, copper, magnesium, nickel, lithium, and cobalt. And this is an important consideration as we move forward. We recognize that given the long delay in when a mine starts up and when it delivers its byproduct or its metals. And so we've seen a decline in inventories in copper, aluminum, zinc, and nickel. So we recognize that there's going to be a press for these metals, even as supplies are low, which means that we will see the mining sector ramp up and prices move higher. We recognize also that as China opens up and their manufacturing output increases, it's a big user of these metals. And finally, the green demand is also driving copper consumption. And so as you see here, 2024 is a peak on estimate, and still stays elevated even into 2025. When we look at copper, metals, and materials um, in the models, I moved an allocation into materials and selected the equal weight materials ETF by Invesco, or the ETF symbol RTM. And so when you look at this chart, there's a lot of information here, but let me point out first, the blue line is the RTM equal weight investment, the blue line. The green line is the price of copper and the change. The black line is a um, year over year change in the metals and minerals price index. So what we take away is that we see this decline in the indexes and in the copper pricing. And once we see the economy turn, once we begin to see the potential for China reopening at some point, then we see a move in not only the copper price, the metals and minerals price index, but also an RTM. And I expect this trend to continue as China reopens and the desire for more EV cars spurs the need for those important metals. Speaking about China post-zero COVID reopening, I have also moved money from the US to China, Southeast Asia region in the models. And quite frankly, it's because those countries, those economies, their GDP are going to grow faster than the US, the UK, and even Euro. They have, especially in China, have been locked up for so long. They have a massive amount compared to GDP, a massive amount of excess savings that they've accumulated over time. And when we look at the inflation level, um, the U.S. is the orange, still elevated at 6.4, but China's inflation rate is down at about 0.8 on an annual basis. So a much more accommodative economy. When we look at the Goldman Sachs current activity indicator, we can see clearly that as the economy declined, of course, again, due to this zero COVID policy, when the policy ends, we see this current activity indicator shoot up pretty dramatically. And we can see that that comes from the consumer activity as well as the manufacturing activity that I spoke about earlier. My anticipation is that this trend will continue. One of the fuels for this trend is the money supply. And I've talked about this in the past. On this upper chart, you can see the purple line is the US money supply, and the orange line is the S&P 500. So we had our COVID recession. The US government pumped money into our economy, and we saw what had occurred to the US equity markets. We're now on the backside of that with the money supply declining slightly using quantitative tightening as well as increased interest rates, and we're beginning to see this decline, or we see this decline in the S&P. When we look at the China money supply, we have seen that they are in an accommodative phase. They are increasing the amount of money in their economy. They are working with property developers to help manage the issue and the glut in that industry. And we're beginning to see the Chinese economy and markets respond. Both Goldman Sachs and Morgan Stanley see a 5.5% or higher GDP and average annual returns for 2023. And that growth in China will also expand to its neighbor countries in Southeast Asia. Thank you for the time. And if you have any questions, please let me know.